just sat down and looked at some of the new features that we have with Preapp 1003, and I gotta tell you guys, it's remarkable. Your ability to communicate with your leads, with your real estate agent partners, and with your clients through Preapp 1003 video chatting is just nothing short of remarkable. Preapp 1003 is the best product I've seen in the mortgage industry for not only running the flow of your mortgage after you get a transaction, but actually getting a transaction, getting a new client, turning that person from a prospect into a client of yours. I can't think of a product that does anything like what Preapp 1003 does. I'm not doing it a service here, but your company should look at a corporate solution with Preapp 1003 because not only is it going to be the most effective piece of technology that you have, chances are it will also save you money. So today's show is going to be a little bit wordy, but I think this is an important message and I want to make sure I share it with everybody so you understand exactly where we're at. So stick with me. About 5 years ago, I said that the mortgage broker would see significant growth. The reason, when the market heats up, the broker channel expands. That was part of it. I also said because it's cheaper, it will look more appealing to loan officers. I said that when brokers come back, they won't feel restrained by the stifling nature of Dodd-Frank and its offspring, the CFPB. I said that brokers will not have the burdensome compliance departments telling them no with their marketing strategies that they had with their banking operations, and as a result, the broker channel will take market share away from bankers. Now, we didn't exactly need a crystal ball for this one now, did we? But surprisingly, not a lot of people saw this coming. I then said that if regional banking operations wanted to keep pace with the resurgence of the mortgage broker, they would need to lax their position on compliance, or simply run the race with ankle weights and lose every time. I said this: the market would lead the charge back to a more centrist position on compliance for which consumers would ultimately be the winner: lower interest rates. We're now in the middle of this right now. Kind of. You see, there's been accusations recently of something along the lines of usury by mortgage bankers with veterans on their VA deals. That some mortgage banking operations are overcharging vets. Now, that would be true if the higher rates that the mortgage bank is charging meant that that banking operation was actually making more profits through the higher rate than what a broker is charging. But is that the case? Here's a question that I have for you. If a mortgage broker who sets the rate with a veteran is making more money, a higher commission, even though they're selling that veteran a lower interest rate, could it not be argued that the broker, not the banker, is also engaged in some form of usury? Is this the insidious, cannibalistic, mudslinging new nature of the mortgage industry, where we pit the bank against the broker? Which, by the way, hurts everybody. Is that true? Now, I say this because we just learned a couple of days ago from the Mortgage Bankers Association that mortgage profitability has hit an all-time low, with lenders losing $200 on average for the loans that they're writing right now. So is writing a loan at a rate where you actually lose money usury? Yet loans where you make money is not usury? The whole thing is kind of ridiculous, isn't it? I mean, the whole argument that was brought up as a means of being transparent is really anything but transparent now, isn't it? See, this argument and tactic of throwing some mortgage companies under the bus for the benefit of other mortgage companies, not so ironically, seems to always have the same winners and the same losers. And that leads me to believe that some self-appointed leaders of the mortgage industry are all too content slinging mud and pulling the entire industry down as a means of giving the perception of elevating a few. Always the same few. Now, of course, you could say, well, at the end of the day, Brian, if the rate with company A is lower for a veteran than the rate with company B, then that's all the proof that you need. Company B is hurting veterans with their higher interest rates. And I understand this argument. I explained that mortgage banking, company B in this scenario, with a higher interest rate, could very well be making less or no money. So I think the notion of any type of usury has been dispelled. But I get the point. A lower interest rate for a borrower is a lower interest rate. But the question we should be asking ourselves as a whole industry is, why is company B's rate higher, and why are they not making money, and what is the industry, and in our scenario, the veteran, getting for that higher interest rate? Now, answering this question and wouldn't lead so many to believe the accusations that we're hearing right now that seem to be simply agenda driven. Now, this goes to my initial point on the direction of the market. The major reason for the higher costs with the banking route is the massive costs associated with new compliance rules and implementing those rules post Dodd-Frank. Rules that had to be implemented a decade ago with new technology departments to support new protocols, and brand spanking new compliance departments, and all the associated costs to ensure new protocols are in place to work flawlessly. Like it or not, this is what mortgage banking operations had to do post Dodd-Frank to ensure that they would survive the last decade. And understand, this was expensive, and more importantly, it was required. Brokers, by and large, due to size and timing, have been able to avoid much of these higher costs. As a result, they're now looking at rate sheets that don't have new middle management and compliance departments trickling down into the rates. So do these new costs of compliance that have led to higher rates benefit the veteran? Well, I guess that's up for debate, but I'd say no. I'd say I'd rather have the lower interest rate on my easy to understand 30-year fixed rate loan and let the banks figure out this whole compliance thing and all the costs after they fund my less expensive lower rate. But there is a fraction out there that disagrees with me on this point. So here we are, 5 years after my prediction, at the exact crossroads I spoke of. Will the mortgage banking operations around the country begin to offload their overpriced compliance departments and all that it entails in order to streamline their operations so that they can offer more competitive interest rates, just like brokers? Or will they toe the line like so many do and allow the investments up to this point in their compliance departments stop them from making decisions that will make their rates more competitive? Honestly, probably the latter. Because one thing with so many banking operations, they're pretty fantastic at reacting to things too darn late. Of course, they're not going to say that. Mortgage banking operations are going to say that they're keeping their rates high and their margins thin because that's the responsible thing to do. That the higher interest rates benefit the veteran. A better word than responsible thing to do would be the safe thing to do. No change is the safe thing more than the responsible thing. Now, brokers, bankers, crystal balls, compliance enforcement is coming back. The question is, what is it gonna look like? I'm pretty much of the opinion if we get an enforcement heavy-handed legislature and president, they will surely dust off the CFPB and jump back into the policy through punishment strategies that we saw nearly a decade ago. And when that happens, they'll go after banking operations, not brokers, because bankers have deeper pockets to pick and have bigger profiles, which means those that follow the route of the broker will have a higher likelihood of getting busted in the near future by laxing their compliance departments. You know, a damned if you do or damned if you don't situation that we've all become too familiar with in the mortgage industry over the years. All of this means that we will continue to see the broker channel continuing to grow, the banking sector continuing to shrink, all as a result of policies past, present, and future. What makes this so ironic is that Washington used the term broker interchangeably with banker and basically claimed that brokers were the cause of the meltdown for everything. A totally absurd assumption. Yet those that believed brokers were the problem are all but guaranteed through their policies that brokers are going to write more loans in the future. Unintended consequences of policies, something we've also become all too familiar with over the years. So there you have it. I hope you understand there's no side being taken here. We're advocates of an industry as a whole and those you write loans for. We don't have a dog in the fight over here, but we do believe that any conversation about how we got here and who is winning and who is losing should not just talk of transparency, but truly be transparent. Yes, mortgage banking operations are, by and large, offering higher rates than brokers on most all products, not just VA loans. But it's not as a means of getting rich and screwing veterans, as is being implied right now. It's to pay for legacy compliance departments and all associated costs that were all but mandated a decade ago. Something brokers have, by their nature, been able to avoid. Now, broker, banker, candlestick maker, it doesn't matter right now who you're working for. The idea is not to get caught up in the things you can't control and focus on the things that you can control. That's your past, your current, and your future clients. Focus on your production and what you're offering and how you can get better, and that is the only way that you, the loan officer, broker, or banker, is going to win. When we get caught up in the rough of finger pointing and finding blames for our lack of production, it only stands to hurt us as individual loan officers even more. The best thing you can do is keep your eyes on the prize. Hope this helps.